Okay. Hi everyone, welcome back. Just hope everyone is doing well. My name is Kai Jun, and for those who are joining for the first time, I'm a second year student in Econs and Finance. I've been investing for 5 years as an FA, Fundamental Analysis. So I'm doing this out of passion because I like passion fruit and I'm also passionate. Yep. So before we begin, looking into our goals itself, there will be times whereby it's going to be very tough, to achieve it, or there are times whereby it's going to be a breeze. But it doesn't really matter because in order to get there, what we need to do is to start. If you don't start, there won't be a breeze or there won't be tough along the way. So therefore, concluding the caption, not now, when. I'm not a financial advisor, and this sharing be viewed as educational and entertainment purposes only. So, okay, might not be as entertaining, but yeah, if you want to take further actions, do consult your own advisor or do your necessary research for yourself. Yeah. Okay, let's start. From like how I always do is we do the outlook of what's happening around the West, what is affecting Singapore before we begin on the actual topic itself. So from the macro outview portion, US unemployment rate has went up to 14.7%, close to 15 already, which trigger unrest within the citizens itself, causing riots and protests, which is still ongoing at this point of time. Additional 5% could be added on top of the 14.7, reaching almost 20%. This 5% is inclusive of workers that are absent from work due to the pandemic. So workers that are minimum wage, for example, like workers within the retail industry that is closed due to the force of closure from the government. So similarly to Singapore itself. So shopping centers are not allowed to open. Those are considered temporary absence worker. So this whole thing results in a higher debt as majority doesn't have the saving culture within their particular society. So their culture is more of like putting to get credits and to really spend money that they don't have, and they're living paycheck to paycheck. So despite the current pandemic and negative news, markets continue to rise, therefore therefore we can see the current, I would say, bullish trend that we are seeing, which I will touch on in a bit. So APEC, Asia Pacific outlook isn't as optimistic. Trades is being disrupted. Farmers and manufacturers are feeling the, I would say, are suffocating in a sense. Protest outbreak within Hong Kong itself has actually resumed upon the lift of their lockdown. Real estate is additionally real estate is currently feeling the heat slowly, if not for the cooling measures implemented by the respective government in the respective economy itself. Upon I would say the least of the particular lockdown earlier compared to the rest of the world, these two countries, which is China and South Korea, are seeing new cases after reopening their streets, which is currently monitored closely by the states. So that would one way or another affect Singapore in terms of our circuit breaker. Yes, we are not being locked down, but it will affect the decision, I would say, that our government will be made in the future.
Jones back to it. Back to his old ways.
Sorry. Okay, so moving for looking into the micro aspect, Singapore latest economy rate is at 2.4%. Forecast is leaning towards the number as the forecast number is leaning to the higher numbers as we enter 2020 itself. And I think before we end off on the news, all the negative news, I think we should put in some positive news to talk about the animals in Singapore Zoo. They are allowed to roam freely. Yeah, give me a while. I think okay. Sorry, I just got to mute everyone. Yeah, so to add a little bit positive news into this webinar itself, amidst all the bad news, we will talk about the animals in Singapore Zoo having a little bit of freedom as we speak. So yeah, the main topic I want to talk about under current affairs today is the difference between market and economy itself. So there's many people questioning why is the economy doing in such a dire state, but the market is still continuing increasing or rising, or having this bullish trend that's ongoing. So first thing first is we need to know the difference between market and economy itself. Market is a forward-looking, I would say, environment, whereas for economy itself reflects the data that happened currently or in the past. So that's the difference, the very huge difference. So market is consists within economy, but economy consists of many other things. So if you put it simply, market itself is within the public sector, means things that can be traded on and everything. Whereas for economy consists of both public and private. So private sectors are companies that's not listed. For example, Tesla is listed, but SpaceX is a private company. So this is a very good indicator lah. Further on, if let's say I were to use example, the difference between Netflix and Ford is okay. So if you're doing, yes, I know they are of different industry and different sector, but in terms of business wise, I want to let you know the difference between market and economy comparison. So for market cap itself, Netflix is at almost $200 billion valuation, the worth lah. For Ford itself is $20.84 billion. I mean, you can just Google it online. So, however, the employees that Netflix has is only, as of 2019, is only 6.7K, but Ford hire over 190,000 employees. So we can see in terms of how these two different companies affects the economy very greatly lah. So for example, if Ford's factory were to close down, how many thousands of individuals that's out of job, which will indirectly affect the economy in the sense. Whereas for if Netflix were to close down, only 6.7, I would say workers is going to disrupt the economy, which is not that great comparatively to Ford. However, looking at the market, now we talk about the market, because just now we talk about economy. So now looking at the market itself, a drop in 10% valuation from Netflix is equivalent to the valuation of Ford. So a drop in 10% is about $20 billion, which is equal to the entire valuation of Ford itself. So we can see the dire effect. Whereas for a 10% drop in Ford is only $2 billion, which is not going to affect the economy in much sense. So that's the difference between market and economy, and we got to understand further. So if you got any further question, we can talk about this at the end during the Q&A part. If not, let's move on. Okay, so these are the 5 savings accounts that I have researched on. I will assume that they are beneficial for individuals like us students or adults that are just stepping into the working force itself. So personally, I have 3 different accounts meant for investment, savings, and emergency funds. And I'll talk a bit more and share a bit more in a bit. So for students, my recommendation is to use Jumpstart as well as POSB Sayer. Difference between Jumpstart and Sayer is Jumpstart is essential a savings account whereby you can take in money or put in money, everything. The only criteria is it only caps at, the 2% is only capped at your first $20,000 in terms of savings, and it's only for applicable for people below 26 years old. Yeah, so as for POSB Sayer, right, it's more of like a fixed day. Like you put in money on a monthly basis, but you cannot take it out. If not, you will sort of like lose the interest and something like that, similarly to a fixed day. So that's the 2 comparison. You can use it for your emergency funds or for your savings itself. Whereas for adults or working individual, I would recommend DBS, Multiply, OCBC, and UOB, because they do, in order to reach the interest rate of over 3% in your savings or 2% for OCBC case, is that you need to spend a certain amount of money and to inject funds into the saving accounts on a monthly basis. And this too is not an easy feat. It takes some, I would say, it takes some cash, some monetary wise. So moving on, we got to understand credit and debit itself. To put it simply, debit is money going out of the account, whereas for credit is money coming into the account. So example is putting your card on tap when you go to when you get a drink at the bar itself. So fundamentally, debit is positive, whereas for credit is negative. However, credit is not all that bad. We got to understand there are perks coming together with credit. For example, when you use your credit card, you get your cashback, your discounts, your rebates, the point system that allows you to claim rewards, as well as probably free stuff, the monthly movie vouchers you get, or the flights ticket to go to some holiday. So yeah, credit allows you to leverage, spend money, incurring a temporary debt. So if you don't pay it off, on a timely basis, it will then realize into an actual debt, which will eat into your savings or disrupt your particular investment goal or savings goal, your plan. So this leads to my next point, which is having a good credit score, paying on due date, use credit card responsibly and wisely, limit the numbers itself. Limit the numbers of lenders, loan applicable and inquiries to a minimum. So what I mean by that for the last point is that try not to incur from multiple lenders, as this might seem to the lender that you are desperate or in need of cash, and they might be reluctant in terms of lending you lah. So yeah, credit card, they offer incentive and additionally lah, so they offer incentive as well as consumer protection and warranties itself. So for those credit card holder, you should know what I'm talking about. So why is credit score important? And I feel that every individual, once you start working, I think it's a good practice or good habit to start owning a credit card. Just one, don't have to just pick the best of the rest, things that is within your means as well, to build your credit score. So why I say so is it allows you to have a lower interest rate in the future when you want to lend money or take a loan from the bank itself. The confidence from the lender when you take out the loan is there, in the sense that the banks is more willing to lend you money instead of questioning so much in the future. So it's a higher chance of loan approval as well when you want to purchase your car or your house in the future. So that's one of the very good reasons as to why you should build up your credit score in a sense. So ultimately, like your savings account, I think it's best at the same, irregardless, like actually, to be honest, regardless of anything, it's best to track them efficiently so that you know where your money is coming in, where your money is going out. So now we go to the next point, which is strategy or tragedies. Pardon my pronunciation. Yeah. So you need to ask yourself: are you a student or are you a working individual? Are you someone that have to pay for loans, bills, or even your tuition grants, your tuition bills, your fees, and everything? So at the same time, for your own like daily expenses, for your food, for your transportation, then maybe you're taking care of your siblings or your nephew, your nieces, kind of thing. So you have to factor that in as well. I'm not saying that you should have 3 separate accounts like myself, but split your income accordingly. Know your goal and work towards it. Then from there, document down, literally pen it down. I mean, like not physically. Don't do it that way. You can just use an Excel spreadsheet or use any platform that's out there. Set realistic goal. Don't have to save 100% of your income. If not, you have to eat grass for the rest of the month. Yeah. So don't spend money that you don't have to. This is the quote lah. So don't spend money that you don't have to impress people that you don't like. That is called being stupid. So personally, I have a savings account which is together with POSB, and I have an emergency fund account which is together with Jumpstart. So that money I won't touch and I'll just enjoy the 2% by itself. My OCBC account is the account for my investment related stuff. So be it for my monetary investment like the stock market or whatever, or to causes, to books. Yeah, so these are my investment personal account, what I use it for lah. So depending on moving on for your investment itself, depending on your own risk appetite and everything, which I talk about during the portfolio management, you can pick the respective instrument which cater to your individual needs. So lastly, I feel, and I think it's the most important, is to have an emergency fund, as I can't stress enough of this lah. Because if you don't have, it's gonna be very hard, especially as a Singaporean. And once responsibilities start kicking in, it's gonna start to take a toll and create a burden, I would say, for the future. So moving on from understanding your needs and everything, I'll be talking about a few of the main instruments that you can start looking at as a beginner to start off. So I have covered all these during the financial literacy talk as well as the portfolio management. So for those who actually remember these instruments, I have actually highlighted them in blue previously. So I hope that you have actually done some research into them. So when I cover on them later on, you have a sensing of what I'm more or less talking about. So government bonds itself, like I mentioned previously, is debt issues by the government. They are relatively easier to understand and not too much of a homework that requires to be done. At the same time, I would say it's pretty safe, or actually very safe in terms of investment outlook wise. It's mainly for risk averse individual, people who is, I would say, afraid the fluctuation or the volatility of the market itself. They are very uncertain. One very good bonds that out there is Singapore savings bond. Unfortunately, I think they raised up the minimum sum to 1,000. It used to be only 500. Effective interest rate of at this point of time is 1.05%. Slightly fluctuating around the current SIBOR. Yeah. The opening date is 4th of May, which is already open. The closing date itself is on the 26th of May. So you are still able to purchase for those who are interested in it. The issue date will be on the 1st of June, which is next month, and will mature 10 years later. The good thing about this bond is very first thing first, the risk is you can take it as literally risk-free. There's no risk at all. At the same time, if you anytime throughout the years you really die need the money for any particular reason, you can take it out. There's no penalty, no charges, nothing, no fees. There's no management fees and stuff like that. So this bond is essentially giving you free interest rate of about 1%, beating the current Singapore average interest rate, inflation rate, sorry. So the next thing I'll talk about is Bluechip and ETFs itself. So what are the difference? And for Bluechip, it's generally companies that are of a higher valuation with a greater reputation. So I have listed out the top 10 Bluechip companies in Singapore, and if you like to look into them as a more depth in terms of stock picking wise, you can identify them and do your necessary research and decide which one you want to get. Followed by ETFs. Technically, they are exchange traded funds that track the index funds. So one recommendation I would say is to get STI, which is your Straits Times Index that track the top 25 blue chip in Singapore. So if let's say you don't want to nitpick the blue chips, the individual company by itself, but you want to own the entire, I would say, reflection of the Singapore market itself, you can get STI itself. So STI, there's two. One is Nico, well known as Nico. The other one is Spider. Spider is SPDR. The only difference is the fund size as well as the tracking error. Distribution wise, they pay a dividend of twice a year. Yeah. Okay, so for this regular share savings plan, right? I'm not sure if y'all can see my mouse, but for these regular share savings plans, I'll go into depth in the second part and elaborate more on it, because I probably wouldn't have time for the first part itself. The next on would be something that your insurance agent friends might be very well known or very well knowledge, like they will probably know this better than me. So if I do mention anything wrong, please correct me. So aside from blue chip investment, as well as ETFs and bonds investing, you can seek your advisors for savings plans and investment link policy. So these two things are actually investment instrument additionally coupled together with insurance as well. So to put it in layman terms, savings plans or endowment itself actually allow us to save a sum, be it monthly or quarterly, biannually or annually itself. And many young adults use this to sort of like force themselves to save a sum. So coupled together, there is like insurance coverage as well. So I'm not a financial advisor like I mentioned earlier, but like if you really need an insurance, my recommendation is to get the specific product that cater to your needs and get a fixed D by itself. So you can view endowment plan as like a fixed D plus insurance together. Yes. For my insurance agent friend, please let me know if I'm wrong in this. So yeah. As for ILP, which is investment linked policies itself, or investment linked insurance policy, similarly to endowment itself, your premium is used for the investment related funds lah, and the portion of the return is paid towards the insurance coverage coupled together within the product itself. So same concept. Alternatively, approach is to invest into funds, and get the respective insurance that you require. So different policies offer different coverage and different investment opportunities as well lah. So investment in policy is probably like funds coupled together with insurance plans. So if I'm wrong, please correct me on that. Yeah. So last but not least, I would just like to thank everyone for their time. This is the reference, and this concludes the first part of my sharing. Yeah. So if you all have any questions, we can get to that in a bit. Before we take about 5-minute break, then we'll continue with the second part. Yeah, Valen, what do you mean by yearly fee? For which part? Okay, so for credit card wise, right, not all credit cards have a yearly fee, and not all credit cards has a yearly fee. Some they are able to waive it off for you. You just have to call them. Yeah, most can call to waive. So you all shouldn't have issue with credit card annual fees. Okay, for me, like I mentioned, so there are credit cards where they require you to do a minimum spending. But if let's say you started working and you would like to save as much as you can, my advice is to get a credit card that have criteria that suits your needs. So you can use probably like CrispPay kind of thing. If you are like in a business whereby it forces you to travel around, then I think CrispPay suits you. Yeah. If you don't call, they'll charge you lah. I need minimum spending. Minimum spending wise will depend on the card and the accounts itself. Okay, I hope my sharing is pretty clear, as this is something I'm new to as well. Okay, to talk a little bit more, I think now I have some time, so I'll just share a little bit more with regards to Jumpstart and POSB Sayer. Jumpstart is essentially for anyone that's below 26 years old, which grants them this 2% interest-free interest rate. But it kept a ceiling of 20K savings. So anything above 20K, the interest rate is only 0.1% itself. At the same time, the debit card itself offers you 1% cashback. Is similar to all the SAFRA holders out there. Those who have SAFRA card, your card also allows you to have 1% cashback. And you can go to your POSB or DBS iBanking to go and take out the money every single month or year or something like that. Yeah. So for POSB Sayer, which is just now I mentioned that is suitable for people like us, is if you don't need the money, you can just put it inside money on a money basis. Then from there you can work towards your 2-year, more of like a fixed D kind of thing, whereby you are able to enjoy this 2% itself. Whereas for DBS multiplier, OCBC and UOB, right, there's a minimum spending every single month, plus you must sort of spend additional money and fund that account on a money basis. So in a sense that whatever income you get, you put into this account. In a sense that these banks itself, they want you to park the money with them to increase their the deposit rates. And if you look at the bank from a bigger picture, and that's how banks are able to lend out more money, because when they have more cash on hand, they're able to lend more out. And banks aren't allowed to lend more than, I think, certain percentage. I cannot, it depends on the central bank of Singapore. I believe they only can lend out, actually I don't know the exact number, but yeah, they cannot lend out more than 100% of. They must keep some in terms of for liquidating. Yes. So moving on, this RSSP, which I'll share during the second part, is essentially dollar cost averaging and averaging in terms of buying ETFs or buying Bluechip itself on a money basis at a lower brokerage fee for investors. Yeah. No need. You can one lump sum put in 20K, just park there. That's what I do for my emergency fund. I park my money there, just collect interest 2% every single month. Every single year. Then yeah. So there is no fees, nothing. You just have to open an account with them. Below 26 years old, park in 20K, then don't do anything about it. I think I'm not sure whether any of y'all know this, but there's this another savings, I would say savings account or like an insurance account, a savings plan that grants you 2.5% for the first 10K, I assume, which is Singlife. Singlife. The reason why I didn't share this because it's not actually a saving account. Is this one, save and earn up to 2.5% per annum. For your first, you must start with your $500. For your first 10K, sorry, the subsequent money is only at 1%. So you might want to check on this. This is not really a savings account. It's more of like a fixed D, like a plan. Yeah. Then if you take out no more 2%. So if so it's more of like you put your money inside, then if let's say there's a daily fluctuation, right? So there's a daily calculation of the balance within your account itself. So maybe you put in 20K, right? Then maybe one day out of the 30 days, right, you take out 10K. So the 2% will be calculated. Then after that, from the 30 days itself, they'll average out that 2%. No, they pay is per annum, means per year basis. The 2% is per year. So you put in 20K, right? Your per year, what you're getting is 2% times 20K. Sorry, my math. Times 0.02. You're getting $400 every single year. So if you split up into 12, you're getting about $33.33 every single month. Yeah, like what Tian Mu say. So the 2% is for the whole year term. Don't get it wrong. It's not every single month. No, not compounded. 2 years. Like I say, if let's say your account got 20K, right? Even the interest paid into your account, right? So the remaining, like for example, now your account, your first year is you put in 20K. Subsequent year, after the addition of the interest, is 20.4K, correct? Your 20K itself still got that 2%, but your extra $400 interest rate is only up to 0.1%. Yeah, so which is compounded, man. Compounded, then yeah. 让那个钱滚滚滚。So yeah. Yeah. If like that, then I think I will put in. Okay, so this is the savings plan I'm talking about lah. Y'all can look into it. It's an insurance savings plan, so you can look into it. 2.5%. I'm not saying it's up to your own call. Do your own research. The reason I'm not putting out there because it's not an actual savings plan from a bank. So yeah. Yeah, 2% is pretty good. And their debit card that they issue to you, they offer 1% cash rebate up to $60 per month. Yeah, actually advertising for the banks. Why am I doing it? But yeah, it's okay. So the next one I'll be talking is about understanding of income statement. So we will be right back at about 10:05. So we can have a 5-minute break before we resume. Is that okay with everyone? So that basically sum up the sharing of the first part, while the subsequent sharing I'll talk a little bit about why I'm not, I would say not interested, but why I wouldn't look into STI or why STI is not within my choices of investment. As well as the RSSP, the regular share savings plan, which allow you to do a monthly investment at a lower brokerage fee rates. Then I'll talk about income statement itself and trying to figure out the purpose of an income statement as well. So yeah, if not, I'll end this sharing. Then we can resume again in a bit. So thank you for your time. For those of you who is only able to join for the first half and have something on later on, I just want to say 谢谢你. Yes, sir. So I will be initially sharing.